Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets that companies try to bury deep within their filings. Today we're diving into Archimedes Tech SPAC Partners, the SECO's latest 10Q report, and trust me, there are some interesting numbers hiding in plain sight. Let's get straight to the juicy stuff, the financial tables. These documents can look super complicated, but they tell a critical story about how a company is really doing. This report is for the quarterly period ended the 30th of September 2025. It is essentially a check-in on the company's financial health and its operations during that time. Looking at the company's balance sheet, we see a stark contrast between the start of 2025 and the end of September. Back on the 31st of December 2024, they only had $429,691 in assets. Fast forward to the 30th of September 2025, and bam, their total assets have skyrocketed to over $239 million. That is a massive jump, right? This huge increase is primarily driven by the cash in their trust account, which reached an astounding $237 million. This trust account is essentially money set aside from their initial public offering or IPO. For a SPAC like this, it is crucial because it is the war chest they use to find and acquire another company. The fact that it is sitting at over $237 million shows they raised a substantial amount of capital. On the other side of the coin, their total liabilities also jumped significantly from just under $500,000 at the end of 2024 to over $8 million by September 2025. A big chunk of this increase comes from a deferred underwriting fee payable, which is $8.05 million. This is basically money they owe to the investment banks that help them with their IPO, and it will likely be paid out once they complete a business combination. This line item is super important. It tells us that over 23 million ordinary shares held by the public will likely be redeemed, meaning investors can get their money back soon. This is common for SPACs where investors put money in hoping for a deal, and if that deal doesn't happen or they don't like it, they can essentially pull their money out. The redemption value is listed as $10.33 per share, which is slightly more than the initial IPO price, indicating a small gain for redemptions. Now let's look at their shareholders' deficit. They have an accumulated deficit of almost $6.4 million. This means that cumulatively losses have outweighed profits. For a company in its early stages, especially a SPAC that has not yet merged, this is quite normal. It shows that right now their expenses are higher than any income they've generated through operations, which is expected as they are still in the searching phase for a business to acquire. Moving on to their statement of operations gives us a clearer picture of their performance over specific periods. For the 3 months ending the 30th of September 2025, the company reported a net income of $2.4 million. This income is not from actual business operations, but from interest earned on the cash held in their trust account and their regular bank account. They earned $2.5 million just on the trust account interest alone, and another $17,000 from their checking account. This is offset by general and administrative expenses of about $160,000. Looking at the 9 months ending the 30th of September 2025, their net income jumps to nearly $6 million. Again, this is purely passive income from investments, not from running a business. They earned over $6.3 million in interest from the trust account. Their general and administrative expenses for this period were about $467,000. For the 9-month period, they saw a net income of $5,921,602. And for the 3-month period, a net income of $2,403,801. This income is entirely driven by interest earned on the funds held in trust, not from any operational revenue. The earnings per S-share for non-redeemable shares are also quite positive at $0.08 for the 3-month period and $0.23 for the 9-month period. This is a direct reflection of the interest income earned on their substantial cash reserves. Now let's peek at the cash flow statement. This shows how cash moved in and out of the company. For the 9 months ending the 30th of September 2025, the company used about $694,000 in operating activities. Remember, this is not for actual business operations, but for things like paying administrative expenses and managing their finances. The big story here, though, is in investing activities where they invested a massive $231 million from their IPO proceeds into the trust account. On the financing side, they brought in a huge amount of cash, around $233 million from the sale of units in their IPO and private placements. This influx of cash is what gave them that massive trust account balance we saw earlier. By the end of the period, their cash on hand outside the trust account was about $1.4 million. This is the operational cash they use for day-to-day expenses while searching for a target business. The company states they are a blank check company formed to merge with one or more businesses, and they intend to focus on the technology industry. Importantly, they mention they have not selected any business combination target yet. This means they are still in the search phase for a company to acquire. Their IPO was on the 12th of February 2025, where they sold 23 million units at $10 each, raising $230 million. They also sold additional units in a private placement to their sponsor and an underwriter for another $8.4 million. The total transaction costs associated with their IPO and private placement were quite substantial at over $13 million. A big chunk of that is the deferred underwriting fee of $8.05 million that will be paid if and when they complete a business combination. The management discussion highlights the importance of the trust account, which holds over $231 million. This money is invested in safe US government securities or money market funds. The company can only use the interest earned to pay taxes. The principal stays locked up until a business combination occurs or if the company liquidates. They have about $1.4 million outside the trust account for operating expenses like finding and vetting potential acquisition targets. They mentioned that the sponsor might provide loans if needed, but these are not guaranteed. In this section, they talk about their accounting policies. A key point is that they are an emerging growth company and can take advantage of some relaxed reporting rules. They expect that their cash on hand is enough to cover their expenses until they can complete a business combination. This part details how they accounted for warrants, which are basically options to buy shares. They've classified these warrants under equity and at their assigned values. The fair value of the public warrants was $1.7 million based on complex valuation models. This is another crucial point that reiterates the redeemable nature of the public shares. Over 23 million shares are subject to redemption, meaning those investors can get their money back. The company accounts for this by presenting these shares as temporary equity outside of permanent equity. This section confirms the details of their IPO. They sold 23 million units at $10 each. Each unit came with one ordinary share and half a warrant. The warrants become exercisable after a business combination and expire 5 years later. Here we see details about their sponsor. Archimedes tech sponsors the underwriters oversee. The sponsor initially contributed $25,000, for which they received 5.75 million founder shares. These shares were subject to forfeiture if the underwriter's over. Allotment option wasn't fully exercised, which it was. They also have an administrative support agreement where they pay the sponsor $10,000 per month for office space and services. This is a standard arrangement for SPACs. This part discusses risks like market downturns and geopolitical instability that could affect their ability to find a business to combine with. They also mention registration rights for their early investors and the underwriting agreement details, including that deferred fee of $8.05 million. This section provides details about their share structure. They have ordinary shares, preference shares, and warrants. As of the 30th of September 2025, they had almost 12 million warrants outstanding. This section is the company's narrative about their financial situation. They reiterate their status as a SPAC focused on the technology sector and their intention to find a business combination before their deadline. They are confident they have enough cash to operate but acknowledge the risks involved. They explain that if a shareholder vote isn't required for their business combination, they will use a tender offer process to allow shareholders to redeem their shares. This again highlights the redemption rights available to public shareholders. So what does all this mean? Archimedes Tech SPAC Partners II company has successfully raised a significant amount of capital through their IPO. Their current financial picture heavily features this cash reserve, which provides them with the means to pursue a business combination. The substantial interest income generated from these funds masks the lack of operational revenue which is expected for a company at this stage. The key risk here, as with any SPAC, is their ability to find and successfully merge with a suitable target company within their allotted timeframe. The large amount of redeemable shares indicates that public investors have an exit strategy if they are not satisfied with the proposed merger. The accumulated deficit shows that while they are functioning as a business, their expenses currently outweigh any operational income, which is normal for a pre-merger SPAC. Overall, the company appears to be in a solid cash position to execute its strategy, but the real test will be its success in completing a business combination that creates long-term value for its shareholders. The tech sector is promising but competitive, so their target selection will be critical. What do you think about Archimedes Tech SPAC Partners, the SUCO's financial strategy? Is their large cash reserve a sign of potential or just money waiting to be spent? Let me know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more corporate deep dives. And don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.